Marvin Barth joins us from Los Angeles this morning. Thanks for coming on the show, Marvin. A big part of that performance is the fact you were lending to distressed entities who weren't necessarily able to get loans otherwise. How much appetite is there still? I mean, how tight is credit?
Well, good morning, and thank you for having me on, Margaret. The market is still very good for us. Certainly, the distressed credit market has run up a lot in the last year and a half, but a lot of that has been at the upper end, Margaret, and we tended to focus on middle market companies that don't have as much access to capital markets, and we see incredibly strong deal flow continuing here. We're having great opportunities to originate very nice deals for us that pay very high rates of return and also help these companies grow. But we're also finding very nice opportunities in the secondary market, and I think that part of that is being a value investor, and this is something that, you know, even if you can't originate loans as we can, anybody can look for this in this market right now is value investing, bottom-up investing here. There are opportunities out there, even though the sort of macro trading themes, I think, are somewhat more difficult.
So we've been hearing a lot about, M&A heating up. Some of this, strategic, some of it financial, but a big part of that narrative seems to be buying revenue growth. So when you look at the opportunities out there right now, I mean, how much more of this trend will continue? What do you expect to hear out of this earnings season?
Well, I think that one of the things that's been a dominant theme here is that broader economic growth, which is ultimately going to contribute to aggregate revenue growth, has been very weak. So companies realize that, and the way that they've been generating profits has been through cost cutting. And after several quarters of intense cost cutting, it's hard to see where they're going to be able to cut costs that much more, which means they have to create revenue another way. Well, one thing that they have done is they've really increased their internal cash flow. So a lot of these firms have a tremendous amount of cash sitting on their books, and they're looking for ways to buy revenue, exactly as you say. And so we're seeing that. We saw a lot of announcements from big companies like GE, but we're seeing it across the market that firms are looking for opportunities to go out and purchase competitors. That's useful for us in our business in that when we're exiting positions, the way we typically exit those positions is through M&A transactions.
Well, it sounds like, though, the macro picture you're painting is one in which a better-than-expected earnings season really doesn't mean anything about a healthier economy or an economy improving if you're saying that the opportunities are coming through cost-cutting or, buying growth there, that the fundamentals are still not in place.
Yes. Yeah, and Margaret, I think it's important to recognize that what that means is that maybe it's not going to be this quarter, but over the next few quarters, you are going to see an inflection point in earnings. We've seen tremendous surprises on the upside in aggregate earnings growth because firms have been so able to cut costs and improve earnings that way despite significant declines in revenue in the prior 2 years. But now we're getting to a point where they've cut to the bone. You're going to start to see it in a company here, a company there, maybe across entire industries where the cost structure is fairly competitive already, that they're not going to be able to do that anymore. But we still have the point that revenue growth just isn't there. So in aggregate, you're not going to see the type of earnings growth that we've been seeing, but you may continue to see surprises in individual companies that are able to grow revenue through M&A activities and other surprises.